Well, of course, 3 weeks ago, they sounded fairly upbeat. The dot plot with rate hikes moved up for 2023, and they started to talk about the tapering process. I mean, I think relative to that, maybe some people would have considered today a little more dovish than expected in that they barely started to talk about tapering. I mean, it's clear they're still pretty optimistic, but there's enough uncertainty, and they're being careful enough to avoid a taper tantrum again that they want to go very slowly. But the message is there that if the economy continues to improve, I mean, they will be tapering before too long, but not immediately. Our own guess is that they probably won't actually announce the start of the tapering till December. So we got a good few months to go before that.
Esteemed colleague Steve, always on the button, of course, points out the employment issues that the Fed is having to conjure with at the moment. And surely they must be just scratching their head here because the vacancies are through the roof. The non-farm payrolls number that we had out Friday was not bad at all. And yet we continue to hear about people walking away from their jobs, that the participation rate isn't growing as aggressively as the Fed would like. And of course, there are continuing issues around the headline unemployment number and the hourly earnings figures. How do you think the Fed is viewing this labour market story at the moment? Because it seems a lot of people are just not going back to work, either because their life view has changed because of COVID, or that they're quite happy taking the checks from the government.
Well, I think the Fed is reluctant, understandably, to simply extrapolate from what you're seeing in the numbers right now. I mean, we've obviously gone through a pandemic and unprecedented time for all of us. And yeah, a lot of people are not quite ready to go back to work for various reasons. And part of it is being afraid of COVID. Part of it is not being able to get childcare. Part of it is because how generous unemployment benefits are. And certainly all those things should evolve over time. And I think the expectation is, rightly so, that the supply will come back and that the participation rate will come back some more. Now, do we necessarily go all the way back to where it was in February 2020 when it was 63.3%? It's 61.6% right now. Probably not. There's a secular downtrend in that number anyway. So even in normal times, there's probably a little bit of a downtrend every year. But I think Fed officials are willing to give it time that we will get the supply coming back on. In the meantime, on the demand side, yeah, there's a lot of demand there. And obviously employment is growing pretty rapidly. 850,000 a month is a pretty strong number, obviously, historically.
Jim, I've got a really simple question. If our viewers buy treasuries at the current levels, and I use a benchmark for that, the 1.313% yield on the 10-year, will they make or lose money over the rest of the year?
Well, we would say probably lose. I mean, certainly our rate strategists at TD Securities are calling for 2% at the end of the year. I mean, obviously the Fed has been very wary here about another taper tantrum, remembering 2013. And they're going very slowly on the taper process, just starting to talking about it, et cetera. And they're going to slowly, I think, start building up the signal and potentially stepping it up a little bit, maybe even next week, when the chairman has a semi-annual testimony in Congress. So they've got to start stepping it up. They don't want a taper tantrum, but 10-year yields have dropped about 40 basis points since April. So I don't think that's what they want either. It's hard to get it right. But yeah, we would say if the economy continues to improve and the labor market continues to improve, yeah, a lot of the inflation is transitory, but is entirely transitory? Maybe not. Ultimately, the Fed is tapering. It's not an environment where 10-year yields probably should be 130.